Welcome to The Chemical Show, the podcast where chemical means business. I'm your host, Victoria Meyer, bringing you stories and insights from leaders driving innovation and growth across the chemical industry. Each week, we explore key trends, real-world challenges, and the strategies that make an impact. Let's get started. Welcome back to The Chemical Show, where leaders talk business. We have just wrapped up the third quarter 2025 earnings season, and no surprise, we are continuing to see the patterns that developed in the first half of the year. So today, I am unpacking some key themes from those earnings reports, and then talking about what leaders can and should be doing today as we close out 2025. Some of the key themes that we're seeing: weak demand, uneven performance, and pressure across many segments. And while stabilization is emerging, and I do see a lot of stabilization, recovery is slower and flatter than any one of us would have hoped. So many companies, what we've seen, are revising those expectations to reflect on a longer and deeper downturn. Now, you've heard me talk about this before, the fact that this is the longest down cycle we've seen in probably close to 20 years. And a lot of that is driven by oversupply and insufficient demand, but really it's more of an oversupply game in many instances. I talked about this last week on The Chemical Show with Andrew Neal and Kurt Barrow from S&P Global, and they brought a lot of great insights. So if you have not listened to that episode yet, go get it. As soon as you get done listening to today's episode, go binge listen to last week's episode. You're going to love it. And one of the things that Kurt and Andrew talked about is that 2026, the expectation is going to be flat. So, and not really seeing recovery until 2027. So if I reflect on 2025, I'm going to just say, I think a lot of leaders started the year with hope. Yes, uncertainty, but hopeful that it was going to be a better year. Once we got through the government transitions, which of course, leadership turnover here in the US, but we also saw it in a number of countries around the globe. But instead, what we've really seen is, leadership transition and a whole lot of uncertainty. In fact, when I asked leaders at the Chemical Summit, what are their biggest challenges today? Two things rose to the top. Number one, price and margin. And number two, uncertainty, because we have certainly seen a lot of uncertainty as we've progressed through 2025. So the purpose of today's episode, though, is to unpack what companies have said from their third quarter 2025 earnings reports, talk about what's changing and what leaders can and should be doing to close out the year and to start 2026 strong. These are tough times to be a leader in the chemical industry. And if you're a senior leader listening to this and feeling the weight of making tough decisions in a market that's not giving clear signals, or heck, just not giving the signals you hoped for, and you're looking for perspectives from other leaders, well, two things. Number one, I'm going to say, hey, show up at the Chemical Summit next year. You're going to get that. But that's a long time to wait. Instead, join the Chemical Executive Mastermind. We have a group starting in January. It is a year-long opportunity for you to gain perspective, to strengthen your thinking, and to lead with more clarity and confidence without the isolation that often comes with senior roles. So if that is what you need, and I think you do, as we head into 2026, you can learn more at grow.thechemicalshow.com/mastermind. Hope to see you there. So let's jump into this. Q3 2025, 5 key themes across the chemical industry. And that's how I've framed this, at least this first part of it. And again, backdrop and context, right? So beginning of the year, a lot of change and uncertainty. April 2025, beginning of the second quarter, we knew that the tariffs were coming. We had some lists, and it took a long while for all this to play out. And by the way, it's still playing out. But here's what leaders and companies are saying and what we're seeing from those third quarter earning reports. Number one, demand continues to be weak, flat, weak. It's not, depending on where you're sitting, it's not in the complete doldrums, but it is not great. And a lot of the reports came back saying that they saw volumes declines 1 to 2%. So not necessarily huge, depending on the market that you're in, but not great. And certainly we are influenced strongly, particularly in commodity markets, by overcapacity. Across the industry, certainly a lot of pressure coming from China with that capacity, which is depressing prices and overall industry utilization, right? When you turn and look at specialties, the story's a little bit different. Volumes down modestly, and that's probably where the 1 to 2% really comes in. And there's pockets of greatness, right? I'll just say that. And maybe it's not greatness. How about pockets of goodness? So electronics, additives, refrigerants seem to be more resilient. And segments that are really innovation-led or specification-based, right? If your product's spec'd in and it's needed, those segments are holding up better. From a distribution perspective, it's mixed. Demand is still subdued, especially in Europe, right? And so we've been talking about this. Europe is in the doldrums, but what we're seeing in North America is that it's starting to stabilize, right? So stabilization is what we're looking for here as we head to close out the year and moving forward. And in fact, one of the quotes I've brought in was from Trinsio's president, Frank Bosich. He says, third quarter volumes were reflective of the demand environment we've seen over the last 3 years. This environment has gotten incrementally worse in 2025 as tariff uncertainty has disrupted trade flows and negatively affected consumer and customer sentiment. So, that's a lot. And I think it is reflective, right? So this whole theme of uncertainty has caused challenges. And one of the things that I've heard as well as we've talked with leaders and as people have made statements is first half of the year, there seemed to be a little bit of inventory build, especially those with global trade routes were moving product early to get ahead of potential tariffs. That resulted in some demand decline in third quarter as people were easing out inventory. And we're going to get to that in a little bit because one of the whole things and the part of the playbook that companies are exercising is around cost control. We'll get there in a minute. First, let's talk about pricing and margins. A lot of pressure there, right? So heavy pressure in pricing from global oversupplies, local prices down, right? So we see more pressure in polymers and basic chems, although I've been seeing recently that prices look to be stabilizing and moving up, so that's a good thing. Margins compressed due to low operating rates. Like there is only so far that you can dial down a unit and still be cost effective, and that's one of the challenges. And in specialty, pricing pressures, but those differentiated products offer some buffer, right? And resilience is the name of the game. When I think about pricing and margins, it's finding those points of resilience that allow you to navigate both disruption and those pricing pressures. The third theme that came out loud and clear, in fact, it maybe should have been my theme number one, which is all around cash and cost discipline, right? Cost control, cash preservation, portfolio discipline, so critical. When we look at commodities, and in fact, I'm just going to lead right into what leaders have really said. Let's just take down. We remain on track to deliver more than $6.5 billion in near-term cash support. Now, mind you, remember, they sold off a big part of their business earlier this year. That helps with cash, right? When they went into a joint venture partnership with Macquarie, somebody's going to come in and back and correct me. I'll figure that out. For their infrastructure, for their site management, what I would categorize as OSBL broadly, right? So, but in addition to that, they also said a reduction in CapEx spending of $1 billion, as well as the accelerated delivery of our previously announced $1 billion in targeted cost reductions by the end of 26. So still looking ahead a little bit to next year, but really cost control is important. And Peter Huntsman from Huntsman Corporation said cash generation and cost control remain top priorities for our company. Such a top priority that they actually reduced their dividend by 65%. That's huge. And you guys know, we're going to talk about this again a little bit more when I'm talking about tactics, but you guys know that companies do not like to reduce their dividend. It has not great effects a lot of times on their stock valuations because people invest because they are dividend paying stocks often. But this was obviously a way for them to create financial flexibility and preserve some cash. So cost control, capital discipline, absolutely a core element of our third quarter earning reports. The fourth theme coming out of these third quarter 2025 earning reports is around supply chain, right? And this whole positioning of global versus local supply chain being more pronounced. Trade and tariff friction, right? Boy, that's a good word, are driving shifts in trade flows, right? So it's beyond friction, it's uncertainty. But the fact of the matter is, companies are making deliberate choices to understand, to go to lower tariff structures, to move to more localized supply chains. So depending on the product that you're in, sometimes your supply chains maybe already been fairly localized, right? So I've talked to a variety of players, whether it's in distribution or specialty, where they really talk about localization as being a core part of their strategy and has been. But we're seeing continued shift in customer preference for regional supply to reduce tariff exposure and to reduce complexity, right? Because let's be honest, moving products globally can be supremely complex, as well as you just shorten the lead times, right? So in these periods of uncertainty, shorter lead times, shorter supply chains are beneficial, right? You make, you store, you produce, you ship in closer proximity, which gives you better control and better cost optimization and lower inventories, lower working capital, all the things that companies are working on today. And then the fifth key theme that comes through, and again, no surprise, tariffs and trade policy are really having a big effect. So tariff uncertainty was cited multiple times, like pick a report, do a Control F to search for the word tariffs, and you're going to find it everywhere, right? So it's been cited everywhere. Oversupply combined with tariffs was really increasing pressure on global producers. Companies are taking different strategies, right? So Eastman says that they're, quantified. They actually said they had something like a $20 million tariff headwind that they calculated, and they talked about how they are rerouting supply to navigate those tariffs. And, what we also see though, as we look at specialties, sometimes margins are somewhat protected because of this regionalization and due to tariff barriers. So one of the things we talked about, again, I'm going to point again to last week's interview with Andrew and Kurt, which was this shift towards regionalization. So comes from a variety of places. High energy costs in Europe, tariff and trade uncertainty, other things. And I think collectively I'm hearing across the industry that we are moving to the future of chemicals being a bit more regional rather than global. And one of the things that Andrew said is that regionalization actually protects margins in the short term, right? So again, Europe's selling to Europe on its own cost basis. U.S. is selling to U.S. on its own cost basis. China's selling to China on its own cost basis. You kind of protect yourself from some of the global trade challenges, certainly in these markets that are supremely oversupplied. It creates some buffers when you go regional. Now, things equalize. We know that. And so how long that plays out to be determined. But those are the 5 things that I would say we've been seeing. And then let's talk about what actions leaders are and can be taking. So taking it from those themes, which by the way, was not a great third quarter. So if anybody had an outstanding third quarter, let me know. Some of the third quarter, the positive notes, again, they were all around disciplined financial management. That was the bottom line that I saw as we look through all of it. But where we sit now in November, moving forward into the end of 25 and as into 26, what are some of the lessons we can take from these earnings reports and apply to business today and to next year? So number one, again, I feel like I've talked about this a bit before. I know I have. It's really true. Focus on the segments that really are creating value for you, being very deliberate about what products, what markets, what portfolio you have. Double down. Double down on markets that make sense to you, that have durable demand, that have the right pricing and margins for you. Rethink exposure to those that are oversupplies or really just not as strategic. Now is the time to think about what is your long-term play? Where do you create the most value, not just today, but 5 years from now? Because there is this expectation that M&A is going to be increasing, right? We saw several corporate carve-outs this year. DuPont sold off some of their great textile businesses. I call them textiles. They probably call them something else. But Nomex and other stuff. Science Co. Has carved out their oil field chemical business and others. That is going to continue. We're going to continue to see portfolio optimization from an asset and business perspective, as well as from a customer and value chain perspective. So the opportunities are now. If you're ready to, streamline, it's a great time to streamline. If you're ready to invest, it is going to be a great time to invest. And when I talk to leaders in the industry, was at a conference a couple of weeks ago. I've talked to some other people recently. There is this expectation that M&A is actually going to be somewhat strong in 2026 relative to where it's been because companies are right-sizing portfolios, market exposure, et cetera. And so the time is right. So focus on those segments that really create value for you. The second one, and we have been working on this and talking about it, and I just can't emphasize it enough, which is strengthen regional supply and operating models, right? Optimize your supply chain. This is never going to stop. We are the decade of the supply chain. We have all of these new nuances coming to play. Tariffs, supply chain disruptions, understanding long-term value. This is also an area where focusing in on your digital tools will help, right? Getting smarter about how you're planning and managing your supply chains is supremely critical. So that's my number 2 thing that people are doing. The third, protect your margins, right? Through smarter pricing and simplified cost structures. So this is around being crystal clear who your high value customers and your lesser value customers are and how you serve them. It is looking at your portfolio, your customer portfolio, and optimizing it. Optimization gives you strength for your own business. Sometimes we talk about cutting the tail, cutting long tail portfolios. By the way, somebody else wants to pick up that portfolio, serve those customers better, create more value in the value chain. It's a great time to do that. And simplify your assets and SKUs. One of the interesting things, and I think sometimes we let things get complicated because there's opportunities. Oh, there's an opportunity for me to sell X. Just because you can doesn't mean you should. And understanding the overall cost to supply, your cost structure, where the value really is, not just today, but for the long term, when you look at your customers and your product portfolio becomes really critical. And focusing in on the core. And not just today's core, but tomorrow's core is critical. And doing it early will help. The fourth thing is improving demand visibility and forecasting discipline. So again, at the Chemical Summit earlier this year, one of the top things that leaders wanted, they said, if only we could have better forecasting. Now, okay, guys, I'm going to tell you, we have always wanted better forecasting. Who does not want better sales forecasting? It's always been the dream. What's stopping you, right? That's my next question is what's stopping you? Sometimes it's not getting real, right? So there's this need for pragmatic realism in our demand visibility in our forecasting, right? So it's nice to say, well, I think I can do X, Y, and Z. Great, but what can you really do? And clarity and certainty are always valuable. Always, always valuable, especially in the land of forecasting. So tighten those customer insight loops. Again, we have so much at our hand. Number one, talk to your customers more. Number two, use the digital tools at hand to help interpret data and patterns so that you can support your own business and support your customers with real-time signals rather than just historical assumptions, because the industry is changing too much. Our demand is too volatile. Our markets are shifting. This is really the time to use data, to use AI and digital, and to have some really frank conversations to improve your forecasting. And then my fifth, it's fifth, but it could be first because it underpins a lot of this. What are leaders doing today? What can you be doing? Again, continuing to prioritize cash, capital discipline, and selective innovation and investment. So cash management is not about saying no to everything. It's about saying no to the things that don't make sense and saying yes to those that do. So preserving financial flexibility, that's one of the things we heard from Huntsman as they talked about cutting their dividend. We're hearing this from others. It's really interesting. A number of companies have either cut their dividend or are considering it. So Dow cut their dividend earlier this year. Huntsman just cut it here with their third quarter earnings reports. Evonik says it's under review. ScienceCo says it's under review. So we're in this spot where cash is king. Cash is always king, sometimes more than others. And just getting pragmatic. And when times are tough, it's the right time actually in many ways to make a change. Make a change to some of your policies and your practices and reset. Because it's really a reset opportunity for many when we look at prioritizing cash, capital discipline, creating that financial flexibility so that you can be stronger in 2026. And that when we see that uptick, and we are, and when we see these really positive markets, and we will, you're ready. So that is it for today. Okay, I'm going to circle around one more time to the mastermind. If you're a senior leader that's listening to this and you know that you would benefit from a high-level peer group to help you think more clearly, navigate uncertainty, and strengthen your leadership skills heading into 2026, that is exactly what the Chemical Executive Mastermind is for. It is created for you. It is a curated peer advisory group designed to give you clarity, perspective, and confident next steps. We bring in experts from across the industry to talk about topics. You have an opportunity to hot seat and get some feedback on some of your leadership challenges and opportunities, and really grow your business, yourself, and take it to the next level. So the next cohort starts in January. I would love to see you there. Start the year strong with the Chemical Executive Mastermind. Go check it out at grow.thechemicalshow.com/mastermind. That is it for today. Third quarter is done. We're here in the middle of the fourth quarter, hoping for solid stories at the end of the year. That is my expectation. We'll see. In the meantime, thanks for joining me today. Keep listening, keep following, keep sharing, and we'll talk with you again soon. Thanks for joining us today on The Chemical Show. If you enjoyed this episode, be sure to subscribe, leave a review, and most importantly, share it with your friends and colleagues. For more insights, visit thechemicalshow.com and connect with us on LinkedIn. You can find me at Victoria King Meyer on LinkedIn, and you can also find us at The Chemical Show Podcast. Join us next time for more conversations and strategies shaping the future of the industry. We'll see you soon.